Welcome, everyone, to a very special Japan Stock Podcast edition of our Deep Dive. Whether you are prepping for an investment committee meeting, maybe analyzing the shifting SaaS landscape in Asia, or you're simply curious about how modern tech giants are architected, you are in the exact right place.
Yeah, we have a really fascinating one today.
We do. Today, our mission is to unpack the investment thesis, the recent financial reports, and we are covering everything from fiscal year 2024 through early 2026, and really get into the hidden business logic of a Japanese software powerhouse, MoneyForward.
Right.
So, okay, let's unpack this. We are looking at a fascinating mechanical shift here. How does a company deliberately and honestly aggressively burn cash for years just to capture market share, suddenly flip the switch to profitability, and then fundamentally rewrite its entire capital allocation strategy?
Well, what's fascinating here is that the true story of MoneyForward isn't just about accounting software or tracking your personal expenses. When you look under the hood, it is actually about the architecture of a digital workforce. It's a masterclass in capital allocation. Specifically, the art of ruthlessly shifting resources away from good opportunities to go all in on the absolute highest return on investment. We are looking at a company that's navigating massive transitions, not just in their balance sheet, but in their core identity as a business.
And to really understand the mechanics of where they are going, we need to establish the foundation of where they came from. MoneyForward's founding mission is pretty straightforward. It's Money Forward. Move your life forward.
Yeah, a great tagline.
Right. And they started with this core goal of solving financial anxieties so that people, and eventually massive enterprises, can actually take on new challenges. It's a very human-centric origin story for what has, become a highly clinical, efficient tech machine.
It is, and that cultural foundation flows directly from their leadership. CEO Yusuke Tsuji's management style is frequently described by analysts as highly passionate, exceptionally positive, and deeply involved in the day-to-day vision. But what is critical for you to note, especially if you're looking at this from a corporate governance perspective, is that they are actively avoiding the classic founder trap.
Right, the founder trap being that scenario where a company scales to $1 billion valuation, but every single operational decision still bottlenecks at the CEO's desk.
Exactly. You want to see institutional maturity. And MoneyForward is actively working on succession planning to ensure the corporate machine doesn't over-rely on just one personality.
Which is rare, honestly.
It is. A prime example of this was the recent transition of the chief financial officer role, handing the baton from Kanesaka to Nagao. That kind of seamless executive transition proves they're building a durable institution, not just a monument to a founder.
Which brings us to the actual engine of that institution. Let's break down their core business lines, because they have undergone a massive evolution. I mean, they transitioned from a household consumer app into an absolute B2B powerhouse.
They really did.
They operate across 4 main segments now. First, you have the home segment. This is what most everyday consumers in Japan know them for, the personal financial management app, MoneyForward MA. It's an incredible top-of-funnel asset for brand awareness.
Right, but the brand awareness is just the hook. The second segment is the absolute engine of the company, and that's the business segment. This is their B2B SaaS, providing back-office efficiency. We are talking about cloud-based accounting, HR, legal, and IT management.
The sticky stuff.
Exactly. Then third is the finance segment. This includes their venture capital arm, like the HIREC Fund, as well as B2B billing and factoring services.
Let me jump in there to clarify for a second, just to make sure we're all on the same page. When we talk about factoring services in this context, we are essentially talking about providing businesses with cash advances on their unpaid invoices. Right?
It's right.
It's a way to smooth out a company's working capital, which makes MoneyForward not just a software provider, but a crucial liquidity partner for these businesses.
Precisely. It embeds them even deeper into the financial lifeblood of their clients. And finally, there is the fourth pillar, the X segment.
Right, the X segment. This is where the strategic maneuvering gets highly specific. This segment focuses on DX, or digital transformation services, specifically targeted at financial institutions.
In practice, this means taking a regional bank that might still be relying on, 1980s mainframe mindsets and paper-based processes and dragging them into the cloud era.
Kicking and screaming sometimes.
Right. And in December 2024, MoneyForward actually spun this segment off into its own independent company.
Which is a highly calculated structural move. I mean, by spinning it off, they give that unit the agility it needs to deepen partnerships with regional banks without being bogged down by the broader corporate bureaucracy of the parent company.
Yes.
It essentially isolates the regulatory and operational complexities of dealing with legacy banks.
It's a very smart way to ring-fence that specific risk and upside. But let's pivot to the timeline, because the chronological growth story over the past couple of years is where we see the financial mechanics really start to turn.
Oh, absolutely. The definitive milestone hit in fiscal year 2024. After years of strategic, deliberate losses driven by aggressive investments to capture market share, MoneyForward achieved full-year EBITDA profitability of 1.7 billion Japanese yen.
And we really need to pause and appreciate the mechanics of that profitability. For anyone who needs a quick refresher, EBITDA earnings before interest, taxes, depreciation, and amortization is essentially a proxy for the actual cash the core business operations are generating.
It's the lifeblood.
Exactly. They didn't just stumble into this profit by accident, and they certainly didn't do it by slashing essential research and development. They executed a massive 11-point EBITDA margin improvement.
So, and this is what every analyst looks for. How do you improve margins by 11 points without gutting your own growth engine?
You rely on the magic of the sauce J-curve. For years, MoneyForward was spending heavily on sales and marketing to acquire customers. In the SaaS world, we track this closely through customer acquisition cost, or CAC.
The dreaded CAC.
Right. That aggressive acquisition burns cash up front, pushing your profitability down into the negative that's the bottom of the J shape. But once those customers are locked into the ecosystem, the recurring revenue, the annual recurring revenue, or ARR, begins to compound.
The payback period hits.
Exactly. The initial acquisition cost is paid back, and virtually every yen of subscription revenue after that drops beautifully to the bottom line.
I always think of it like planting a commercial orchard. For the first 5 years, you are buying seeds, leasing tractors, watering the soil, seeing absolutely no fruit, to just setting money on fire.
That's the bottom of the J.
Right. Then suddenly, the trees mature. You are harvesting apples year after year, and your incremental cost to pick those apples is next to nothing compared to the setup cost.
That is a perfect analogy. And the harvest we have seen in just the past 1 to 2 years is staggering. By the first quarter of fiscal year 2025, the business segment ARR hit 32.13 billion yen.
Wild numbers.
That is up 26% year over year, and they have amassed over 400,000 paying corporate customers.
And those 400,000 customers aren't just a vanity metric. They represent immense leverage, specifically pricing power. In June 2025, MoneyForward instituted a price revision for their small and medium business, or SMB, clients.
Yes, a critical moment.
That move alone drove an immediate positive ARR impact of 2 billion yen.
See, this is the ultimate stress test for a software company. When management can raise prices and the customers don't churn, meaning they don't cancel their subscriptions, it proves the product is no longer a nice-to-have.
It's oxygen.
Exactly. It has become mission-critical. It's the central nervous system of their clients' back offices. Trying to rip out MoneyForward to save a few yen on a subscription fee would cost these businesses exponentially more in operational chaos.
The switching costs are just too high. And they aren't just squeezing more revenue out of their existing small businesses. They're aggressively moving upmarket into the enterprise space. They are deploying what they call component-type ERP.
Right, enterprise resource planning.
Yeah, for you listening, these are the massive software suites that run a company's entire backend. Historically, adopting an ERP meant a mid-sized company had to force a massive, rigid, multi-million-dollar software installation that took 2 years to implement.
And those legacy implementations often fail or go wildly over budget. We've all seen the headlines. What MoneyForward is doing with component-type ERP is lowering that barrier to entry.
How so?
They allow a mid-market client to adopt individual modules. Maybe they start with just accounting, then 6 months later they add HR, then legal. All of it seamlessly integrates. It is a classic land and expand strategy.
Get the foot in the door.
Exactly. They prove the value with a smaller contract and then inevitably expand the account. This is driving up their average revenue per account, or ARPA, quite significantly.
That makes total sense. And that expanding cash flow from the domestic business isn't just sitting in a bank account either. It is funding their push across borders, which brings us to their overseas operations.
A very interesting part of their thesis.
They have this long-term global vision driven by a corporate phrasing. I actually find rather poetic a desire to, quote, see that exciting scenery. But the execution behind the poetry is highly strategic. They currently rely heavily on development hubs in Vietnam and India.
Right. Right now, about half of their engineers are non-Japanese.
which is huge.
From a structural standpoint, this is a crucial competitive advantage. Japan is facing a severe demographic cliff and an acute shortage of IT talent. By building robust development centers in Vietnam and India, MoneyForward secures a scalable pipeline of world-class engineering talent while managing their labor costs.
But they aren't just using overseas markets for cheap development, right?
Yeah.
They are actively trying to capture foreign market share.
Yes. Look at Southeast Asia. They hold a stake of over 40% in Macari, which is Indonesia's top HR and accounting SaaS company. CEO Suji even sits on their board, which gives them immense oversight and strategic alignment in a rapidly growing economy.
And they're making calculated moves in the U.S. market as well, using very cautious M&A. For example, their acquisition of Whipplewood CPA's PC. They aren't just blindly buying revenue, they're acquiring deep domain expertise in the world's largest software market to build out AI business process outsourcing.
Exactly.
But let me pivot us to the macroeconomic environment for a second, because this is where the conventional wisdom gets flipped completely on its head. When we look at global macro risks, say, the unpredictability of the Trump administration's tariff policies, how does that actually impact a domestic Japanese software company?
It's a phenomenal question, and the reality is deeply counterintuitive. Let's take tariffs first. A domestic software company like MoneyForward faces very limited direct impact from U.S. tariffs. They aren't shipping steel or cars across the Pacific. However, indirectly, macro pressures act as a catalyst. When tariffs squeeze the profit margins of Japanese exporters, those companies are forced to look inward for cost savings. They have to become fundamentally more efficient to survive.
So they turn to automation.
Exactly. How do you do that in 2026? You adopt SaaS to automate and ruthlessly cut back-office costs. So geopolitical macro pressure can actually accelerate MoneyForward's sales pipeline.
That is a fascinating dynamic. Hard times for the broader industrial economy actually act as a tailwind for efficiency software. What about the currency markets? The yen has been highly volatile, and we are looking at a scenario where the Bank of Japan is continuing to hike interest rates, while the U.S. Federal Reserve is expected to execute rate cuts through 2026.
Right, and that divergence in central bank policy, the BOJ hiking while the Fed cuts, naturally leads to yen appreciation. For decades, a stronger yen has been viewed as a nightmare for traditional Japanese corporations because it makes their exports more expensive globally.
The classic exporter dilemma.
But again, MoneyForward flips the script. They actually benefit from yen appreciation. A stronger yen directly reduces their operating costs, specifically for foreign server infrastructure like Amazon Web Services, AWS, and other U.S. dollar-denominated SaaS tools they rely on to run their own internal business.
So as the yen strengthens, their profit margins organically expand.
Precisely. It's a built-in macro hedge.
Let's transition into the hidden logic of their capital allocation, because this is where the senior analyst perspective really shines. Over the past year, we have seen some ruthless prioritization from management.
We really have.
In November 2025, MoneyForward literally sold off SmartCamp and BizHint, which made up their entire SaaS marketing segment for a 6.3 billion yen special profit. They completely deconsolidated it.
Just cut it loose.
Yeah. And prior to that, they formed a massive joint venture with Sumitomo Mitsui Card Company, SMCC, for their home segment, bringing 19 billion yen in cash into the group.
A massive war chest. But wait, let's pause there. I have to play devil's advocate for a second. You're telling me they deliberately sold off a growing, profitable marketing arm. In corporate Japan, empire building is the standard playbook. Executives love to hoard subsidiaries to make the conglomerate look bigger. Why on earth would you give up guaranteed profitable cash flow in a tough macro environment?
Because management understands return on invested capital.
Yeah.
This is the hallmark of elite Western-style capital allocation operating within a Japanese firm. They recognize a fundamental truth. Not all revenue is created equal.
Okay, unpack that.
Yes, the SaaS marketing segment was profitable, but it was growing slower and had a much lower ceiling than their core B2B software engine. By liquidating those slower growth assets and securing that 19 billion yen from the SMCC joint venture, they amassed that massive war chest we mentioned.
Right.
And they are pouring that capital directly into their highest ROI opportunity, the business segment and artificial intelligence. They are starving their good ideas to overfeed their best ideas. Starving good ideas to overfeed the best ones.
Yeah.
I love that. That requires incredible discipline. And that brings us to the ultimate variable for their future growth, the thing that could completely rewrite their valuation multiples, quote, digital workers.
Yes.
They rolled out the MoneyForward AI Vision 2025, and they're not just talking about bolting a simple chatbot onto their existing software. They are investing 2 billion yen in fiscal year 2026 alone directly into AI.
This is not just a tech buzzword being thrown around on an earnings call to appease retail investors. The strategic goal here is highly quantifiable. They are aiming to use AI to increase their business segment ARPA by 30 to 40% by FY 2028.
That's massive.
And they expect to add 15 billion yen in pure AI-driven ARR by FY 2030. They are executing a fundamental paradigm shift in what they actually sell. Historically, MoneyForward provided software, a tool that a human accountant or a human HR representative uses to do their job faster. Now they are moving toward providing autonomous back offices.
They are creating a brand new market category for digital workers. It's the difference between selling a construction worker a better, lighter shovel and selling the construction firm a robot that digs the hole completely autonomously. If you are selling the robot, you aren't just competing for the client's software budget anymore. You are competing for their payroll budget.
That is the nail on the head. That completely changes the total addressable market.
Yeah.
And what is brilliant is how they are funding this R&D push.
Right.
They are drastically optimizing their advertising spend.
That's right. They dropped their advertising expenses to just 13.8% of sales, which actually beat their own downward guidance. They shifted away from expensive spray-and-pray mass media TV commercials and moved to highly targeted, efficient digital channels.
Which makes perfect sense. They have reached a scale where their brand awareness in the corporate sector is high enough that they don't need to blanket the airwaves to get a meeting.
They've already won the mindshare.
Exactly. They can rely on product-led growth and targeted enterprise sales teams, take the massive savings from that marketing budget, and dump it straight into AI development.
Which is exactly the kind of internal capital recycling you want to see as an investor. They are funding their own future without diluting shareholders.
Precisely.
Speaking of the shareholders, let's bring this all back to you, the listener. What does this massive transition mean for your pocket? What is the shareholder return policy here? Are we looking at a shift toward big, traditional dividends now that they are solidly profitable?
No. And frankly, if you are investing in this kind of growth story, you shouldn't want them to pay traditional dividends right now.
Right.
Management's attitude toward capital allocation is extremely clear. They are aggressively reinvesting for long-term equity value. In a high-growth SaaS model, returning cash to shareholders via dividends is often an implicit admission from management that the company has run out of high ROI internal investment opportunities.
A sign of stagnation.
Exactly. MoneyForward believes that their internal rate of return on hiring that next elite AI engineer or developing that next autonomous accounting module far exceeds the 2 or 3% yield a shareholder could get if handed a cash dividend.
Growth is the ultimate dividend. If they execute, the capital appreciation of the stock will dwarf any quarterly payout. And they're targeting massive numbers to prove it.
They really are.
For fiscal year 2028, they want to hit 100 billion yen in revenue, over 80 billion yen in pure SaaS AR, and an EBITDA of 30 billion yen. That means they're aiming for a 30% plus EBITDA margin and a 20% plus operating profit.
Those are staggering targets.
They are promising a future where they're not just a big revenue generator, but a highly, highly lucrative cash machine.
And those medium-term targets serve as their ultimate commitment to the shareholder. They are essentially saying, trust us with the capital today, let us build this digital workforce, and in 3 years, we will deliver a cash-generating enterprise of a scale rarely seen in domestic Japanese software.
So to summarize the essential variables for you to watch over the next 1 to 3 years as this story unfolds, first, monitor MoneyForward's ability to smoothly execute those SMB price hikes without triggering a spike in customer churn.
Critical mass.
Second, watch their ability to successfully penetrate the mid-market and enterprise space with that modular component-type ERP. And third, and arguably most important, keep a close eye on how effectively they deploy that massive 19 billion yen cash infusion into viable, revenue-generating AI technologies.
Exactly.
Whether you are looking for actionable stock insights or just a masterclass in business strategy, MoneyForward is proving to be a textbook example of knowing exactly when to pivot from growth at all costs to ruthless, targeted profitability. Thank you so much for joining us for this special Japan Stock Podcast edition of our Deep Dive. Keep your eyes on the numbers, keep questioning the consensus, and we will catch you on the next one.
Before you go, this raises an important question for you to explore on your own. As MoneyForward integrates AI to the point of literally creating digital workers, they are no longer just selling a software tool. They are effectively selling labor. If this transition succeeds, are they still a SaaS company? Should they be valued like one? And perhaps most terrifyingly for the industry, how will traditional accounting firms, business process outsourcers, and legacy software competitors even begin to compete against a software company that provides an autonomous digital workforce that works 24/7 without a salary?